Hey everyone, welcome back to another edition of Super Prime UK with your MJ Group Super Prime valuation specialist, myself, Rob Cohen.
And myself, James Wild.
Hope you're all well. So much happening in the last week. It is so eventful out there. Uncertainty, volatility, economic changes, week in, week out. We are here for you, giving you all of the latest data, intel and updates. And it is needed because we are in the fastest moving market that we have ever seen, and it looks like that's here to stay, James.
Yeah, in a traditionally very quiet period of the residential property market, these sort of summer holiday periods, Rob, the sort of end of July to August period, it's normally a period where a lot of estate agents on holiday, they're slightly lower staff, but in the current market, things are, lots of properties trading and new instructions have been at good levels, Rob. So if we get straight into that, this week, 327 new instructions this week. And, you know, a couple of really strong weeks on the sale figures. Last week, obviously, almost record high for the year, 181, and this week 170. So really strong there in terms of the sales. There's obviously a lot of overseas buyers back in London, and also domestic buyers are remaining active in these months, Rob.
Yeah, it looks like a lot of people are away, which they are, taking advantage, especially the European market, and having longer summer holidays post pandemic, COVID, etc. At the same time, the level of activity and volume and in valuations and inspections is non-stop. So it's as if there's a dual market happening of the European market that's on holiday at their second homes, whichever country they come from, then the non-European and those Americans who are flooding to London, taking advantage of that cheap pound and entering the market.
Yeah, it's been another bumper year in terms of not only the numbers across the main sort of London sector, but also, like you say, Rob, in those prime London markets, a lot of, again, trophy assets, 10 million plus sales, which we've seen in the first half of 2022. And just to bring you some further data in terms of the more sort of the wider house price indexes. Halifax released their monthly data a few days ago. The sort of growth figures on their house price index, they've obviously seen that slowing. We're now at an annual change of 11.8%, so 11% higher the prices at this point in time to 12 months ago. And that does include that last month of July, which the market shrunk just slightly at 0.1%, and that's the first decline since 12 months ago, in that period just after the stamp duty holiday ended, Rob. So that data there is really capturing what we're seeing in the market, I think.
Absolutely.
Just to bring in some other headline data there, Wales again showed the strongest annual growth in the UK, possibly with some more sort of race for space there, people moving out of some of the larger sort of urban areas there into more the sort of countryside there. First week of August was quite a mixed week for a lot of the sort of people looking for sort of new mortgage finance there. We obviously had the Bank of England scrap the requirement for lenders to impose additional affordability tests on borrowers, which were announced back in June. Those have now come in now, so that has been removed, the stress testing. But days later, obviously, the Bank of England furthered this up with a large base rate increase.
Yeah, I think, as we said last week on the show, that was on the cards, no surprise there, and I think that's only going to further fuel the refinance market for the remainder of the summer and the rest of the year as further hikes come in, James.
Yeah, and then just to give you some further details on the lifting of the restrictions there, the affordability test, which was previously required by lenders, that was to assess the potential for borrowers to be able to afford an interest rate hike of up to 3%. So this will alleviate some of the pressure on the mortgage market and possibly give some lenders some more flexibility in structuring those deals.
Yeah, I think the loan to income threshold or the income multiplier is a key, more meaningful measure for most lenders. So whether that's 4.5%, 5% multiple, that's going to be the key indicator for lending. At the same time, those restrictions will be a breath of fresh air for mortgage brokers who are looking to do as much activity as they can, and any barrier to them placing a mortgage is going to be welcome to them.
Yeah, we're going to have to see how that is formed in the market. And then just to recap, obviously on the 4th of August it got announced that the first half a point base rate rise in 27 years. That got brought in the 4th of August now, so a lot of banks and lenders will be obviously rebasing all their mortgage products to reflect that in their latest offerings. The Monetary Policy Committee voting 8-1 in favour of the rate rise to 1.75. So again, we have to wait and see what comes later this summer, Rob, if there are some further rate rises just to dampen the inflationary market and economy which we're in currently. Just in terms of some analysis on the mortgage market again there. So in quarter one 2022, 82% of the outstanding mortgage debt was on fixed term rates there. So they won't initially be affected at all by these base rate rises. And just to give you a bit of flavour there, so less than a decade ago this was only about just over 30%. So people have really sort of taken up those sort of cheaper, more competitive fixed rate deals over the last decade on those sort of 2 or 5 year fixed rates, so up to 82% of the market on those fixed rate deals. There hasn't been, from what we've seen, Rob, a seismic shift for many borrowers coming out of longer term fixed rates who would not have benefited from the record lows in 2021. Effective mortgage rates of those coming out of a 5 year fixed, if we go take June 2022, the sort of average there was about 2.15%. If we take 5 years earlier, that's only marginally higher. June 17, the sort of average rate there was 2.05%. So those people coming out of the 5 year fixed at that particular point in time, Rob, wouldn't have seen a vast hike in terms of the mortgage rate which they could have achieved in the market, albeit those existing mortgages which are due to expire in the coming months, there's going to be a slight gap widening there in terms of the mortgage finance just being slightly more expensive than it was around 5 years ago.
I mean, I think that's going to be a minimum of a point, and it could even be 1.5 points depending on where things go.
Yeah, we'll have to wait and see what happens in the mortgage market there, what rates are achievable, and just a cost of living viewpoint. And obviously not all households at the moment are being affected equally, as research from the Institute of Fiscal Studies has suggested that the least affluent 10% of households have experienced the CPI inflationary increase of 3 percentage points higher than the most affluent 10%, largely due to these households spending a higher proportion of their income and disposable income on energy and food. So it is likely that those households where these rising costs of living is going to bite a little bit harder, and especially those in rented accommodation as well, and obviously if they're not in a position to move. 2 year fixed mortgages, Rob, this rate has jumped up quite dramatically over the last 12 months. 12 months ago we were averaging about 1.3% for a 2 year fixed mortgage. We're now up at 3.46%. So that rate has really soared in the last 12 months, and it's likely to go higher, Rob, in terms of that sort of just under 3.5%, which we're seeing at the moment.
Yeah, I think that's what we just touched base on. What people are going to be facing as their 2, 3, 5 year fixes end is the reality. There's going to be an increase, and that increase, depending on what their previous rate or terms were, could be anything from 1 point, 1.5 points, even 2 points, depending on what the starting point was. So I think that is going to compound the cost of living, energy prices, and the inflationary pressures that we're seeing currently in the wider economy.
Yeah, and in terms of those mortgage products, they've now only got an average shelf life of around 17 days, so that's shorter than ever. So those looking to refinance, or if they're using any sort of mortgage broker, are almost having to sort of rebase what mortgage product they're looking to tie themselves down to and facilitate a mortgage with. So that market is moving quicker than ever in terms of those mortgage lenders bringing new products to the market and removing somewhat reactive to some of the rate changes, but also in terms of those affordability criteria, which have now been slightly tweaked as to how those are calculated by the lenders. I just wanted to touch upon, Rob, we've obviously in the rental sector across the UK, we've got a few things which are going to be coming in the next 6 to 12 months. Obviously a few white papers, the Renters Reform Bill 2022, which is going to be some new rules for landlords and also renters. We've also got the MEES, the Minimum Energy Efficiency Standards white paper, which could be lifting the minimum EPC rating up to a band C. So that is going to have quite a dramatic impact on the rental sector. But obviously, like we've spoken about recently, Rob, we've got that rental market has been moving towards that build to rent. So we are going to have in the next sort of 5 to 10 years a real influx of new rental stock. So we're going to have to see what impact that has on the market. There's going to be sort of a removal of no fault Section 21 notices, which is whereby you sort of serve notice for a tenant to vacate the property. It's going to give tenants a lot more rights in terms of how those tenancy agreements are structured. Student properties will be included in that rental reform. However, the purpose-built student accommodation will be exempt, as a lot of that sort of accommodation is run sort of slightly more like serviced apartments with on-site facilities somewhat, so it needs to have a slightly different structure to it. But yeah, in terms of that sort of rental sector, Rob, we're going to see a lot of changes over the next 6 to 12 months. Do you think that's going to have an impact on sort of the rents that people pay, or how people sort of go about renting property, the duration they stay in a flat or a house?
I do think that it could lead to longer terms, more protection for the tenant. I also think from a mortgage perspective, the energy efficiency and EPC rating is having a greater strength on mortgageability and more preferential rates, and that is going to be a strong influence over time as the market moves on in terms of sustainable mortgages, green mortgages, etc. We've talked about it on the show before, and that is going to strengthen as time goes by, as more lenders put a greater emphasis on more energy efficient properties.
Yeah, in terms of sort of obtaining vacant possession, that's going to be slightly different in the way it is undertaken from the landlords. I mean, it still will be obtainable in certain circumstances if they're looking to sort of move into the house themselves, reoccupying the property, or whether there's any extenuating circumstances where they need to sell. In terms of the rental increases as well, these will have to be agreed 2 months in advance. So a few differences there, a few tweaks in terms of the sort of standard ASTs as we know them, but I think it's ultimately going to provide a little bit more transparency in how that sector works, and both the sort of landlords and tenants will have sort of their positions a lot clearer.
Thanks, James. Great weather out there at the moment. Hopefully everyone's enjoying an amazing summer, one of the warmest, hottest on record. Just had the Commonwealth Games, which was a great advert for UK athletics and Birmingham. What else is happening, James?
Well, we've got the start of the men's football season, which we're off to a fly. We've got sort of Spurs top of the table, a few surprise wins for Bournemouth and Leeds, two of the teams which I was possibly tipping to go down actually, Rob. So we're going to see how that plays out this season. And obviously Champions League clubs, that sort of Liverpool, can they sort of overtake Man City this year and win the title? 3rd and 4th spots up for grabs. I don't think Manchester United will be competing for those spots, but certainly Chelsea, Arsenal, Spurs will be in the mix for that 3rd and 4th place.
And for all those fantasy league pundits and experts out there, you're quite into that, James. Who are your top picks for this season?
I think it's got to be Haaland. I think most people's picks. Off to a flyer brace in the first week. Jesus as well for Arsenal. He's going to be the main man. I sort of, golden boot this year. Can Harry Kane, can he score in August? We'll have to wait and see.
Looking forward to it, and a World Cup year as well. And I think we've got the WSL starting shortly as well. And I think there's going to be huge interest in that following the great success of the Euros. And season ticket sales have gone through the roof. So looking forward to the women's season. Anything else for this week, James?
That's it from me.
Brilliant, great to have you back. Hope everyone is well. Great volumes of downloads, podcasts, YouTube watches, interaction, engagement, LinkedIn. Thank you so much. Tremendous loyalty and commitment, and great community we're building here in the super prime UK, and now with our EVA European piece. If you haven't watched that, subscribe to that, or got that data, please do get it. Contact us or download it, or subscribe through our websites. Great data that we're giving you here every week for free, and now great pan-European data that will be coming out quarterly. Strongly advise you get that, and anything else you need, you know where we are. We're here week in, week out to give you the best and most up-to-date property data, intel, lending, transactions, and everything property related. Thank you so much. Great to have you back, James, and we will see you all next week. Thanks, everyone.
Thanks, Rob. Thanks very much, everyone.